Welcome everybody. All right, let's get this party started. Turn this music down just a tad. How's everybody doing this morning? Yes, I agree. CTT hot beverage. It cracks me up every time I see the actual emoji name. How's it going, everybody? Good morning. We got a lot to discuss today. Wow, we've got Russia's going to invade. Russia's pulling troops away. The Federal Reserve's going to have this emergency rate. Oh, maybe not. Okay. The Canada's enabling banks to freeze assets. Whatever. Got a thread here about some stuff going to the weekend I was looking at. We've got some new projects I want to start talking about. Got a lot of really good charts and really good setups. So this is going to be exciting. Again, thank you all for being here with me this morning. Let's get into it. What do we got here? Van Life Morning. Anybody got any questions before we get started here? Post the questions, because I'm going to try my best to get through all this news, and then we'll try to have some time for Q&A here. I don't want but if I see something really interesting, I might talk about it up front. But let's get started with all the news. But before we do, as usual, I'm not a licensed financial advisor, so anything that you hear me talk about here today is just my opinion about what I see in the markets. If you were to take trades blindly based on anything that you hear me talk about, you're going to be losing all your money living in a van by the river with Doge and Boneholder here. All right, so I jokingly said in our CTT Discord the other day, I wasn't joking. I said it's going to be so funny when like all the media said, hey, okay, it looks like Russia's going to invade on Wednesday. I'm like, there is zero chance that a major, invasion happens on the day that the media is announcing that it's going to happen. There's going to be some twist here. But sure enough, this morning, military drills have finished and troops are returning to base. Some troops are withdrawing from the area. Does this mean that they're never going to invade? I don't know. I'm not an expert in international politics. I don't know if this is a fake out. They're going to pull troops and then invade when people least expect it. I don't know. The one thing I do want to make clear, though, as we go through this, there's so much international news right now, and it affects crypto and our investments in crypto. Am I still holding a bullish bias? Great. Thanks for the question. We'll get to that. I want to make it clear that on my channel, I try to be non-political, right? So we don't want to discuss any politics here, right? Or my leanings on any political things going on. My opinion about, you have plenty of other places to go to hear about political opinions and what people think about things. And I have Alan on from time to time, and I've asked Alan to talk about his perspective on China and UK. But what I also want to make sure is that nobody perceives me asking him to talk about China and the UK, his perspective on it, the markets, because he's lived in both those places. I just want us all to have an international understanding of the news and the data, but I'm not trying to push any political agenda. You'll not hear me talk about this side of the aisle versus that side of the aisle, any of that nonsense, right? We're just here to talk about the data and look at what the data is telling us in regards to our investments, right? You can go other places to hear about politics. So please understand that as I talk about Russia and Canada today, it's hard not to sound political. Just please don't misrepresent anything that I'm doing as any sort of political. I'm not taking a position as to whether I support one cause or another. It's purely reporting on the data and how it affects the markets. So the Russia thing, all I know is that the markets were pricing in global uncertainty around that, and it appears that based on this early reporting this morning that they've finished up and troops are withdrawing, that's less pressure, less uncertainty in the markets, and thus we're seeing a bounce in the markets, right? All right, the Federal Reserve Office calls for a measured response to inflation. They're going to do a rate increase, but they don't. I think probably next time, but they don't want it to be too substantial. They haven't settled on a big rate increase. It's all talk. It's all rhetoric. And this is scary. This is actually kind of scary because, frankly, if the Federal Reserve really wanted to rein in inflation, the fact of the matter is they would have already taken action. They would have already raised rates in the last couple of meetings, right? We've had high inflation prints for months now. So the posturing may tell you that they're trying to control this via rhetoric more than action. I do believe they will take action because they're going to have to. But this also kind of tells me that it's probably not too uncomfortable for them to see kind of high inflation. Like, they're not that concerned. I kind of almost wonder if they were expecting the inflation print to be higher, and it to be 10 or 12% maybe, which I guess real inflation is probably 12% or so, right? You can get different opinions about that. I would say about 12% is probably real inflation. But nonetheless, the CPI is saying 7.5%. But I almost wonder if they're like almost happy with that and they're pretending like they're not. I don't know. But this emergency meeting didn't do anything. Markets began to bet on double-sized rate increase, half a percentage point. But that hasn't happened yet. So again, the markets are bouncing. So there's a lot of fear and a lot of headwinds. And did I get this picture ready to go here? Let me see if I got this this picture here from one of our Discord members. A screenshot of a comment. I'm going to throw this one up on the screen real fast. Here we go. This is Satchel on our Discord channel. Said this. Basically, just don't trade the news. It's a waste of time and dubious speculation. And I said, it's truth. Just trade the charts. So the charts, this is where we're going to talk a little bit today about risk management and why, stop losses or otherwise just knowing where you're going to trim a position is really, really important because none of us know what's going to happen tomorrow, right? So we have to always, there could be a black swan event at any time that nobody's looking for. So we always have to be on our toes and using proper risk management strategies around all these global uncertainties. Now, I posted this. Good morning. Fed meeting minutes today. So, I think that article. We got the note. I don't know about the meeting minutes per se, but we got reports here that they're not going to do an increase today. They're planning an increase for March, right? That's the plan, is to do an increase in March. And I think they're probably debating 0.25 or starting out with 0.5 in March, right? But either way, the market has now priced in a rate hike for March. Clearly, it's already forward priced in. So a 0.25 print will probably send the markets up a little bit. A 0.5 print probably be maybe a slightly negative reaction, but ultimately probably fade that move and more sideways consolidation or something to that effect, right? So that's my opinion of that. Now, I posted this again. As soon as I posted this, I was like, I hope people don't think I'm trying to be political. And somebody in here commented, they commented about something about the truckers or whatever. And I try to make it clear, like, look, I'm not necessarily supporting the truckers and their movement. As I understand it, the group that's actually occupying the city is actually different than the group that's blocking highways and bridges and stuff like that. But nonetheless, when the officials here come out and say that they're giving banks the ability to freeze assets without having to inform or to get a court order first. That's just whether you agree with it or not, whether you agree with the movement or the reason they're doing this or not. But that is simply giving banks more power and to take action unilaterally, which does restrict and it puts more gives them more authority and more control. And so that's what I meant by the Super Bowl ad. It's just simply the move that they're giving banks more power. The more central, and that's just banks are already centralized. You give centralized banks more power. That's in effect an ad for decentralization and Bitcoin, right? All right. Mining question. How would you set up a small mining operation? 10 to 20 ASIC miners using solar panels as a source, asking for a friend. That's pretty much exactly where I'm at. Like, I have about that number, and I don't have as much solar as I'd like because on my land and my house, I could have coated my whole roof in solar, but we decided to start kind of small and doing the sunny side of the house. But for the most part, that's what I would do, right? So I haven't done it yet because I'm still trying to get my bearings around. Are we heading into a multi-year bear market, or is this going to rebound? And so what I'm waiting for is a clear kind of opportunity. Oh, you have 10 acres you can clear. That's perfect. See, I have a lot of land, my family land, in a couple hours from me, that I could probably make use of too. So that's kind of where I'm planning to put some solar facility and a workshop and things. But yeah, if you had 10 acres to clear, that's a good start, right? So build you a nice little workshop, 10 to 20 miners. What's great about that is, frankly, you have a lot of write-offs if you do that. Right? If you do this, clear 10 acres, put 10 to 20 ASIC miners and a bunch of solar, there's a lot of potential to write off a lot of that capital investment into that project. So probably the best thing about it is the ability to write off that capital investment. All right. I'm sharing my whole screen. Wow, I didn't realize. Hold on. Let me try something here. Oh, whatever. You guys get all the tabs and everything. All right. Oh, no, it is edited, cropped out. Okay. All right. So I said coming into the week, I had this little thread here that I was stopped out of trades into the weekend. I've been doing this lately. I've been being more aggressive about stops and or taking profit on pumps late in the week and just kind of waiting out the weekend and then re-entering after the weekend. It's been working out pretty well, but one of these days it's probably not going to work out so well. But I don't necessarily always want to close out going into the weekends. But after a big price move like this, I was pretty aggressive with stop losses. And pretty much anytime you get that aggressive with stop losses, you know you're going to get stopped out. So yeah, on the chart here, I'll just show you. I got stopped out when we lost this breakout. I was looking at this way up here. So I was posting all these like things I was going to be doing on Discord. I don't know how much I actually ended up doing, but 44.4 is where I got out of a third of my position up here. When we lost, that breakout kind of failed and we bounced back up into it. 44.4 is where I exited. And then the rest of it I exited at 43. Oh, it was higher than that. Oh, maybe it was all the way down here. This right here. I lost this low. I got out at 42.5 or 6 or something. But I sold a third up here and 2/3 down here when it rotated down. And then over the weekend, when I did my research and I felt like the geopolitical stuff may have been overblown and I was just simply going to trade the charts, I had staged orders myself through all these support areas with stops below that area right there, and I got 2/3 of my position filled, and I need to figure out what I'm going to do about that last third, if I'm going to bother with it, try to buy the dip on the next dip, or wait for a breakout, or not bother with it and just live with 2/3 position. But all right, so I'm back in 2/3 of the position. But here's what I was looking at, right? Again, this was Friday, a lot of uncertain macro conditions. Over the weekend, I had time to kind of digest some of the thoughts around the Fed and the geopolitical risks, and you kind of felt that maybe both of those were a little bit overblown. But here's what I see, is I see that, we're really just establishing this trading range and a lot of consolidation. So, thanks, Justin. I appreciate that. I'll answer this question here in a minute. So yeah, I see us. We came into strong monthly support and bounced right off of it, right? And then we broke this downtrend. Now I had some other tweets talked about how we broke this downtrend, right? And so this is a counter trend uptrend that we're in now. So at this stage, I'm more inclined to buy the dip on price action alone because again, big sell off. Big break in structure as we bounce the other side. We're going to get at least a dead cat bounce. That's really kind of what I'm playing at this point in time. However, that said, there's still a lot of data. I guess I didn't post it in here. I didn't post my usual. Let's go look at the net flow of exchange net flow data here. So this is data. Coins coming in and off of exchange. What I thought about over the weekend when I looked at the inflow of coins. So the 11th of February is when we had the last. That was Friday. Yeah. So Friday we had an inflow. Kind of what gave me pause. But then we had this. We didn't have any follow through. We had a small drawdown over the weekend and a very small. So basically, this data was telling me that long-term holders of Bitcoin weren't concerned with the macro conditions or even a Fed rate hike, as this was a net sideways move in coins onto exchange here over the weekend, more or less, or coming into the weekend, late last week and over the weekend. And given the exchange reserve has been dropping so precipitously, these sort of events and uncertainty, if there's going to be a big sell-off, it's probably going to be at least accompanied with a big increase in coins on exchange. But I wasn't seeing that behavior. So I'm seeing this as long-term holders and market participants at large are not too terribly concerned about these kind of short-term risks. So I wasn't seeing a significant risk of a quick move down. And the other reason I wasn't seeing that is you look at open interest, had this little dip and slight increase. Funding rate did go green. Like I know people are still posting that funding rate is still red. It did go positive kind of over the weekend. So that gave me a little bit of pause, but it was very mildly positive. But I'm not seeing a condition for a long liquidation spike. We haven't had a big buildup in longs, funding rate to the long side too terribly much. So there's been a little bit, right, a little bit of positive funding, but it did on Glassnode. They reported a negative funding, mean funding print, right? So this is the aggregation of multiple exchanges. So nonetheless, I don't see a lot of opportunity for a long liquidation on the derivative side. I don't see coins coming on exchange. So I don't see the market and market participants advertising that they're too concerned about these risks. So that's where I started leaning into buying this support area. And let's go back to this. This is one I'm going to start maybe talking about a little bit more. The Mayer multiple, in reflecting on this, I believe it was Glassnode's, one of our Glassnode update videos highlighted this metric, and they highlighted that this is, based on the 200-day moving average. And I use the 200-day moving average largely as a trend indicator, right? Now, I look for areas of support and resistance around those SMAs, but I don't use the SMA, the print necessarily for support and resistance, but I use it as a 200-day as like one of my main trend indicators, or the longer-term trend indicator that I use. And so, as a trend indicator, and I've often measured, the distance from the 200-day moving average to assess risk. That's how I assess risk, is if you get too far detached to the upside, you can see here as price gets too far detached from the 200-day, you're at a little bit higher risk. When you're below it and detached and you get far below the 200-day, you're probably going to have a little bit of a rebound, right? And so that orange line is a 200-day moving average. So the Mayer multiple is a derivative of that 200-day moving average. And you can see here, every time price comes into this green support area, it sometimes it can stay extended below it. And that's, we had this big capitulation event in 2019, for example. So it's not that it can't ever go below it, but it's a pretty good indicator that we're coming into at least a short-term bottom because prices become too far detached to the downside from the 200. And the 200-day, this is called the institutional moving average. So a lot of institutions look to accumulate underneath the 200-day moving average, especially when the 200-day moving average is trending upward and price is below it. So anytime institutions kind of see that, the 200-day moving average is trending upward and prices dip below it, that's a pretty good indication to buy. And so that's a lot of times how they work out, good times, good opportunities to buy. Okay, and so I highlighted that. Short term, we've established a bit of a local uptrend. We're above the 50 still. We're closing right at it. We closed right at it like 3 or 4 days in a row. But since then, we've bounced off this little support area that I identified, and boom, off we've gone. I guess my little support area would end up being a little bit lower than price actually got down to. But nonetheless, that's what we've done here. All right. So, new projects. Let me get to the questions, and then we will get to these new projects, why I like them, and my thoughts about these projects. All right. Let's see. Let's go back to the chart while we talk about Q&A here. Okay. So, if I set up 5 or 6 acres, how many miners can I run? Chris, I was looking at like either a half a megawatt or a full megawatt of solar power. And it was only going to take a couple of acres. It wasn't that big to get. I think 5 or 6 acres, you can get, I want to say 3 or 4 megawatts of capacity out of solar. I think it's roughly a half a megawatt per acre. I think. So yeah, 5 or 6 acres will give you a couple of megawatts. That's hundreds of miners. So that's quite a bit. Let me just double check. Let me just fact check myself. How many acres for 1 megawatt of solar? Let's just Google this real fast. Oh, it's 4 to 7 acres. I was wrong. So I must have been thinking, okay, so I was thinking it was like 2 to 3 acres, but it must have been that half a megawatt. So 4 to 7 acres will give you 1 full megawatt. And a megawatt can power a lot of miners. So you could get a megawatt of power. There you go. So roughly, depending on how much sunlight you have where you're at, you're looking at a megawatt of power for the area you're looking at. So that's quite a bit. Hi, Mindy. All right, back to, are you still bullish bias? Ask HYA5011 on BTC. And I think, tell me HYA if I'm wrong, but I think this is actually Lemmy. But yes, I have a bullish bias because of the fundamentals, and really, like, there's a lot of reasons for it. But again, I look at, let me go look at this. I posted this a while back, right? I look at this behavior, this pattern of behavior here. One of these charts has my, no, here we go. And, you know, in I think, yeah, I've got the 2017 fractal up top here, right? When I look at this behavior, this, you know, boom bust cycle rooted at the halving was the most important event, right? The supply shock that created in 2013 and 2017, I see a big change in behavior as basically the market very aggressively priced in the halving, which tells me, you know, after that, the March halving over here, May halving over here, the market started pricing that in very aggressively earlier, you know, and more aggressively than the 2017 cycle early on. So that told me that more of the market was aware of the halving, right? And so the more that awareness there is, the more that gets forward priced in, or market starts to price it in, you know, more accurately. And so I think this strong run up and then this, you know, slap down of price, again, this is clearly Wyckoff, you know, a Wyckoff pattern. Now, whether that's manipulation or human psychology drives these Wyckoff patterns, you know, I'm still not 100% certain. I don't think I'll ever know exactly. But when I saw this change in behavior, the one thing that I was pretty clear, I've been pretty clear on the whole time, is that this is a permanent change in behavior. This is moving away from this boom bust cycle because not enough people understood what the halving was doing to now probably too many people understand the halving. It's being used against them. So this was all the hype around the halving being used against retail. This was all the hype about an end of the year blow off top being used against nominal traders or retail, we would call them, right? And so the other thing too is in 2018, everybody's expecting the 2018 collapse. And just like this was being, all of this was being used against people looking for, you know, a big price run because of the halving, and then over here because of the end of the year blow off top narrative. The 2018 narrative is now what's taking place, the bear market narrative. And I would almost bet you that you're going to see a series of this type of behavior where it looks like things are breaking down and then it bounces, right? Just like over here we had this, you're going to have the inverse now because it's the market playing people who are looking for 2018 to happen again. So everybody looking for 2017 to happen again got, you know, demolished. And now people who are looking for 2018 to happen again are probably going to get equally demolished. So that's just the psychology of the market part of it. That's a big part of it for me. The other part of it is when I look more objectively at price action here, I look at what's happening with price. Price is being compressed. It is not like, yes, we had a pretty big move from October through April, but then we had a pretty aggressive sell-off, and then we had a bounce back to a higher high, and now we put in now pretty much a higher low, and it's starting to be pretty well established higher low here. So this is a really strong indication to me that this is just a consolidation range, and if I were to peg this is the market changing from that boom bust cycle, right? This was the death of the boom bust cycle. Not only the top, but how fast we ran up, how early. We basically peaked long before people thought we were going to peak, and then we put in a higher high over here, right? So this whole from here all the way through to here was a clear change in the way the market behaves. And so it is my opinion that all of this price action, if I were to draw this extended back here, it's really all this, right? Everything inside of here is the transition away from the boom and bust cycle of the halving, right? Halving based boom and bust cycle to a new market paradigm in which the largest driver of this market is actually on the demand side, rooted in adoption. And adoption, we've talked about this before, adoption metrics are just up and to the right, okay? So I see that. I see this chart. I see consolidation. I see a range-bound market and a lot of consolidation. This might be years of consolidation before we're done with this, right? I don't know. It's already been, over a year. So when we finally break out of this trading range, perhaps we go to the top of the trading range and then back to the bottom one more time. I don't really know per se. All I know is that I see this trading range. I see clear change in behavior. And I see this very much, this whole sell-off was baiting in 2018. People looking for, from the end of December down all the way here, people looking for 2018, revenge trading because they didn't get their blow off top in December like they thought over here, and now they capitulated somewhere through here, and now they're revenge trading to the short side, and now they're again on the wrong side of the trade. So I see so many, like, just the way the market is behaving, it's completely catching everybody off sides at every turn. All this FUD, this little bit of a dip here, look at this. I said it in their Discord. It looks a lot like this to me. Right? That looked a lot like that to me. So that's why I started leaning in as we came into support there. Right? So those are just my general thoughts on the market. Now, then we go to look at the fundamentals, right? We look at coins coming off of exchange. We look at the change in the behavior of the derivatives markets, the funding rate change, open interest still being fairly high, macro climbing. So a big picture, open interest is increasing. You see it's up and to the right? We've had a few peaks, and then this peak here was the long side, was pretty heavy, and then we liquidated the long side. But now it's still up and to the right. So we have a lot more open interest now than we did in the summer. And it is net short currently, right? So that's the other thing too, is the short side of the trade is the crowded side of the trade right now. But I look at that. I look at, these reserve ratios. I look at things like the Mayer multiple and all those other derivatives of data, right? The Mayer multiple I like a little better because it's a derivative of a simple 200-day moving average. Some of these others I don't like as much. For a lot of reasons, yes, I maintain my bullish stance on Bitcoin. It's driven by both fundamentals that support what I'm seeing macro, very high time frame price action. I'm seeing this manipulation of the nominal investor, right? So we ran way too hard, way too fast. Got a lot of people way off sides, thinking that it's just going to keep going up to several $100,000, and then a big capitulation event. And then a lot of people, I guess, weren't expecting a bounce. I don't know why, but people, we're talking about this going back. That was the peak. We're going back to 20,000 or below, and then boom, and then a new all-time high, and then a big sell-off. And now people looking for 2018. This is so typical of what the market does, right? It's constantly in a state of flux, and it's never predictable entirely. It's always going to catch the majority off sides. So, feels like hopium coming back. So yeah, maybe people are chasing price now, right? That's a big. There's going to be a lot of people chasing price. This is still an area of key resistance. I've highlighted this a few times. I think this is where most of the short side open interest was collected, right here around 46 and above. So this is still going to be an interesting area of resistance to keep our eye on. If I were to throw on my 50 and the 200 on here, so the 200-day moving average likely is going to be tested at some point, right? And so that's kind of what I'm looking for, is something in this area. But you see this area of resistance here. I think largely through here, a lot of the short side open interest was developed in this area, especially in this sell-off over here. And then the stop losses are probably going to be above that wick high right there, and then more above that swing high over there. But it feels to me like the market wants to finish wiping out the short side of the open interest, which would put us right around the 200-day moving average, maybe close to the swing high. And then certainly we could roll over from there. So I think that's the other thing to keep in mind, is that I am bullish very long term. Short term, I would not be surprised to see a higher low get put in and roll over. The main thing is, you just look at, I can't help myself but do this. Like I don't use fractals for trading for the millionth time. I do not use fractals for trading. But if we take a look at this spring and capitulation event, like the odds that we get something that looks a lot like this are pretty dang high. And just overlay, look at that. I just overlaid that. Let's grab from the capitulation low. Let's just grab, it's the most ridiculous. I would not be surprised to see something like this play out. But yeah, you see like that, just that a perfect little correction back to basically. So what this was over here, so on the technicals part, what this was is we had this Wyckoff pattern, right, and then the trap put in. And so as we came back into the level where the trap was established, this is that SOS pattern as we come out, right? So this establishes the top of the range, the top of the trading range. This is that spring event. This is that SOS, the sign of strength, right? As you get, and so what we did is we came up, hit the top of this trap level, and then we broke out above it. This is a pretty strong indicator that you're gonna continue higher, right? So you took out the trap high. Good indication that you're going to continue higher, right? And then it resets back down to kind of the bottom of this first trading range. So what you see in these accumulation patterns, or I've been noticing, is it trades in a range. You get your trap, and then it collapses, and it trades in a lower range. You get your spring, and then it bounces, right? So I kind of like the same general mechanics are at play here, but the trap is much higher, and I think maybe because of the scares around some of the market, the market was starting to become concerned about rate hikes and everything else, and the broad markets rolled over quite a bit here, so that might have caused it to capitulate further. But you see this trap, trade, and then you trade in a lower area. Now, what's interesting is I don't know that this was supposed to fall down that much, but it fell down. So we got this lower trading range, and then a redistribution looking type event, and then even a lower trading range. But we've, in a similar fashion, this could be considered a bit of a trap. That's a trap move. For a very, very, very long-term trading perspective, we need to take out this swing high at roughly 52,000, right? If we're going to see the top of this range, what we're going to do is we're going to take out that 52,000 high. A really good indicator that we're not going to see the top of the range, that we're going to go back to the bottom of the range, would be that we break out of this bit of consolidation we have here, but we fall short of making a new high, right? So if we hit resistance right in through here and roll over close to the 200-day moving average and don't ever take out that high, that's a really good indicator that we might go back to the bottom of the trading range, which I don't doubt that that's a possibility, or maybe even almost a probability. Like, I think that's probably the way that we should. That's the assumption I'm making, actually. I'm making the assumption that we're going to get to the midpoint. And if I were to draw this up, this is probably the most accurate way to do this, not looking at the 200-day moving average per se. Just look at the sell-off. We've definitely broken this downtrend, and we're setting up a trend reversal here. The 0.5 the 0.5 level for the sell-off is at 51,000. If you take out that 0.5 level and kind of more importantly probably this swing high right here, good indication, the probabilities, it's not 100% certainty ever, right? The probabilities are if you get price action up here around 53,000, the probabilities are that you're going to continue on and head to the top of the range to find your next significant resistance, right? But if you roll over below the 0.5 or right at the 0.5 and right over this 200-day moving average area, you don't quite make a new high here and you roll over here, odds are you're going at least back to the bottom of the trading range. And in theory, you could go lower. At this point in time, I wouldn't expect us to go lower. There's just too much buying down here. At both times, over here even, there was just really a lot of buying volume. It was pretty good buying volume every dip down. It was pretty, really good volume. And we've seen the same reaction here. The buying volume gives me confidence that this is a floor. So there was a lot of buying volume on this all the way through here on this whole breakout. I can just show you that on the charts. So, I'm not trying to preach too much hopium. Look, I'm really just looking at this chart. I'm seeing this big, huge extended downtrend right into strong monthly support. If I throw on the monthly level, you can see the monthly support very clearly is this box right here. If I redraw the support, that's the monthly support. That's the trading range for the month of June. So after the big red monthly candle, we had an indecision kind of candle at the bottom of the range here, and the body of that trading range is the support area. We got a strong bounce off that support area. You notice neither monthly closed or opened. The January monthly did not close in that range, and we've had a pretty strong reaction, back up the other side. So we bounced pretty strongly off of this support, and all of the volume beneath this area right here. It was really, I guess, yeah, really throughout most of this was actually pretty strong. I can go show you that. But anyway, so I'm not preaching too much hopium here, but I hope that all makes sense to everybody. All right, how long have we been going? So back to a shorter time frame chart. I got a lot of lines on here. I'm sorry about that. Whoa. Well, I'm modifying my scripts here. All right. Auto, that's what I meant to click. Okay. Back to a short time frame chart. I mean, you can see just on a short time frame, you've got these, we're in a range bound again, right? So we established the bottom of the range here in this from the 4th to the 6th. And then we've come back into, the bottom of this trading range over here as resistance. So you hit, if I do a daily, I think it perfectly hit this, like the low daily. Yeah, right there. So you see that when we lost that zone, or we're rejected here, right there is exactly where we initially came up to and got that initial rejection. But then we came to the bottom of this range, and now we're headed back to the top of this range. So, so far, right now, we're back in the same range over here is really what it boils down to. Ultimately. But we'll see if this second attempt will break up to the upside here or not. But all right, back to new projects. So I hope I answered that question well. Let's look at, more comfortable about crypto recovery. This, I'm thinking 2022 is not going to be 2018 is what it boils down to, right? So I was on the fence about that. Didn't want to make that more definitive statement. I think the probabilities are that we're less likely to have a major capitulation in 2022. I can see it in the second half of the year. I don't see it happening at this moment in time. Therefore, I think we have some more strength in alts coming. So these two projects I've been watching closely. Now I will classify. So AZERO is a directed acyclic graph project. So basically, it's like a baby AVAX, or a poor man's AVAX, or a poor man's Hedera, which I think HBAR was pumping lately. Let's go take a look at the top gainers and losers. Let me just show you where these guys are. All right, so ALF0 is similar to AVAX. AVAX is still a little different. AVAX is closer, is basically a DAG, a directed acyclic graph cousin of Polkadot or Atom, Cosmos. But so ALF0 is more akin to like Phantom and Hedera. Let's see here. Was Hedera? I thought Hedera was pumping pretty big. Yeah, today it's up 10%. HBAR. So you can think of ALF0 as a poor man's HBAR. They're very, very similar. I actually kind of like A0's technology better than HBAR's, frankly. And HBAR is number 30 something on the list, and ALF0 is number 3,000 on the list. Top rank. I guess what's the market cap on ALF0? $200 million. And yeah, I like their technology even better than like HBAR. So all right, that's a lot of upside, but it's only available on one stinking exchange, and that is MXC. And then the other project is one that's been around a little bit longer. It's more accessible from a trading perspective, is MTV. Let's see where it's at on the market. Multivac. So Multivac you can think of as a poor man's or a miniature Elrond, really. It's probably the closest comparison is Elrond. It's really very similar to Elrond, frankly. That's the only kind of pause I have about investing too much into it, is I'm already pretty heavily invested in Elrond. And so but number 605 on the list, $40 million market cap. Wait, that can't be right. If it's 605 on the list, how does this have a $40 million market cap? A fully diluted market cap would be $115 million. ALF. Hold on. So A0 has, how does this have a $200 million market cap and it's ranked number 3,000 on the list? Something ain't adding up there for me. Yeah, okay, this can't be right on the market. I don't know. Don't ask me. I have to go look into that. I got to figure out what the actual market cap, tokenomics of these two projects are. That's something I haven't dove into a whole lot. I'm a tech guy, so I was looking much more at the technology. I haven't really dove into the tokenomics too much on both of these, but something's off with that, right? But back to MTV. Multivac, pumping a little bit today too, up 15%. It's basically, like I said, a poor man's. I say poor man's eagle. It's not like it's inferior to eagle, other than it's just behind in development. Um, this one's a little bit probably more interesting for people because it's available more places. I guess it's really just on KuCoin. So you can get on PancakeSwap, apparently, KuCoin, MEXC. But I want to read this one statement that they made here about their project. So they call themselves all-dimensional sharding, right? So sharding is a really was developed as a traditional database scaling technology, right? It's how it's a way to scale databases. And early days, now I think I may have been, as I studied Elrond more and I studied Ethereum's plans around sharding, and I've studied Polkadot. It's a sharded ledger too, but it's a flat sharded ledger. So I think Ethereum and Ethereum and Polkadot scared me a little bit less because they were like flat, predictable sharding. But I've had nightmares with sharding databases in the past in my career in technology. So I may have a little bit of PTSD, but I think my experience comes from kind of the earlier stages of the development of sharding as a technology for databases and as a scaling technology. So as I studied it a little bit more, I started gaining more comfort that this is a pretty viable way to scale a blockchain. Now, and Elrond really is the one that gave me that. Elrond's adaptive sharding really scared the heck out of me when I first really started diving into Elrond, the project. I liked it, but I just was scared about, like, is this really going to be reliable because of how difficult sharding actually can be, and then doing this like adaptive where you can add or reduce shards. But since then, I've seen how they've gone about thinking through that, and I've seen the resiliency of the Elrond platform. So because of that, and then Polkadot too has shown it's pretty resilient as well, a lot of uptime. But Elrond is the one that showed me that sharded blockchains can be very reliable, right? So now I want to read this to you guys because I think it's going to help you understand kind of this whole space. So you're going to hear a lot more about this, right? So if you remember, I believe it was Zalika was one of the first ones to do sharding, right? But let's just go through this. Why sharding over other scaling solutions? Sharding is the only practical and fundamental way to scale a blockchain from the bottom up. That's their claim. From that statement is pretty true though. Like if you want to scale the actual layer 1 core ledger, sharding is one of the more well understood technologies to be able to break up that ledger into multiple smaller components so that you can scale it for multiple ways, while at the same time preserving its original intent of being a decentralized ledger open to everyone. So this is key, right? How do you make it properly decentralized? And what I like about, they call out the same thing I've been calling out for a long time. So let's keep continuing on here. It is the deepest level solution that makes the fewest compromises in bringing performance benefits. The other solutions have severe limitations. DPoS, which any project that does this, this is cheating, right? There's better ways of doing of getting scaling than having a central set of delegated consensus nodes, which is what DPoS is. So it's delegated proof of stake. So basically, you have a central set out of the thousands of potential stake node operators or node operators. You pick a handful, a small collection, to delegate the consensus algorithm to, which is just a form of centralization. I just don't like it. Violates blockchain's original core value of decentralizing and reverting back to a semi-centralization. And this is a problem with a lot of projects. This is why I call out so many projects. And there's different variations of this. Like I talked about on the other day, people were asking me, why don't you like Algorand? And I said, well, Algorand's performance isn't its smart contract performance really isn't that great when you take away, they have a central set of relay nodes that makes their performance a lot better. If you take away those relay nodes, the project can operate without the relay nodes, right? So Algorand doesn't have to have the relay nodes, but the performance is pretty not up to par with everybody else's. But they have these relay nodes on top of it. So not only do they have a centralized component, if you take away that centralized component, their performance isn't as good. Same thing with Binance, BNB, and Solana, for example, as well. Off-chain solutions such as state channels require trust. So this is like layer 2 or off-chain solutions require trust relationships between the client and the state channel provider. So there are some legitimate concerns with off-chain solutions. For the most part, I don't agree with this entirely, but there are potential issues. And The biggest issue with off-chain solutions is when they become centralized themselves. And so they might have a centralized subset of things that they do, and they may, eventually, go back to the main layer one, to get total consensus or to solidify transactions or whatever. But they can become quite centralized, and then they can have their own set of issues. And then the security between them also can be an issue. So the reason I don't entirely agree with this statement is because of how I know that Cardano built kind of the native layer 2 scaling with what they're doing with Hydra heads. It's almost better for security, but that's a different topic, a different point for a different day. But that was built in. So to their point here, that was very built into Cardano. It's not like a separate, completely off-chain solution. It's built into the core kind of project, right? So it is a little bit different. But you see here that the next statement is DAGs, directed acyclic graphs, require way too many network transmissions to be wieldy in an open environment. This statement is, for the most part, true. This is the reason that I've started talking more about Avalanche or AVAX, is because I think that the snowball consensus mechanism that Avalanche uses is by far, by like miles, the best way that of handling this. The orchestration of a directed acyclic graph consensus with this snowball mechanism. It is actually very decentralized, and it is the best way that I've seen to manage this. And what's great about the way that like Avalanche is building is that while they're a DAG, they actually have independent blockchains, right? So they have the ability to do what Polkadot or a Cosmos do, and this interchain communication, but they're able to orchestrate multiple actual blockchains. And so the DAG consensus on top of a blockchain gives it a lot of really interesting characteristics. Very fast finality, very fast consensus, but it's recorded ultimately still on a blockchain. So it's kind of the best of both worlds. And so this is true. This is especially true of projects that, so Hedera, Phantom, IOTA, this statement is very true of them. Avalanche, based on how my understanding of their snowball consensus and it ultimately it goes from snowball to avalanche, right? That's why the project called Avalanche, because they use the analogy of snowball rolling downhill to gain consensus, and then it becomes an avalanche of consensus. That project is the outlier to me, because the way that they handle it is so it's really good, right? So Avalanche is the outlier to this, and then ALF Zero now. We'll talk about that more, maybe in a different one. We'll run out of time today, but we'll talk about why ALF Zero is also unique now. But this statement is true of everybody I've seen except AVAX and ALF Zero. All right, sharding is the only solution that's been proven to substantially improve TPS in decentralized, secure manner. That's a fair statement for blockchains specifically. Multivac believes that the most robust scaling solutions are built bottom up from the infrastructure ground level. For this reason, we use blockchain sharding as our core scalability approach. Same exact thing Elrond's doing. They have a little bit different take on how to build what they call it multidimensional sharding, I believe. And this is all-dimensional sharding, multi-dimensional sharding, whatever you want to call it. This is more of a marketing term. Elrond's adaptive sharding and Multivac's all-dimension sharding, there are some differences, but at the end of the day, based on my research, they achieve a lot of the same ends and have a lot of the very similar mechanisms in doing so. But the big difference is this project is tiny, right? This is reporting $40 million market cap. I don't think that's probably accurate. I think there's something off with this. But it's number 600, right? It's out of the top 100, got a lot of room to grow. And it's, basically it's a pretty compelling competitor to Elrond. Now, Elrond obviously is way, way far ahead with a lot of things. So the Elrond ecosystem is much larger. So it deserves a much larger market cap. But interesting project is this one. And then ALF Zero, we'll save that for another day. So Multivac's the one I'm more focused on right now, because the chart setup too. The other thing about ALF Zero is getting in on ALF Zero now. Let me go to CoinGecko and see what they say about. Let me see if CoinGecko's figured out the market cap situation here more accurately. Let's go look at that real fast. between these two projects. So this is something I'm going to have to follow up and just be very careful, because all I've done is initial research on the technology side, and I'm impressed with Multivac and with AZERO. I have not done a lot of work on the tokenomics side. So do your own research, please. Make sure you understand what the tokenomics are and everything before you invest in these. I've started very small speculative plays, tiny, like less than 0.1% of my portfolio, like by far, for these two combined, right? Just I started putting a little bit into them as I like the technology. I won't put more than a tiny fraction until I really deep dive on the tokenomics, the team, and everything else. But this is reporting a $39 million market cap as well. And does this tell you where it's at on the top whatever list? I mean, it's way down there. It's a really small market cap. 100,000, no, $39 million market cap. That is tiny. Yeah, 679. Let's look at let's look at AZERO. Market cap, okay, trading volume. So, okay, it's not really, so they haven't calculated the market cap yet. So we'll have to do some follow-up on this. That's going to be really important to get the tokenomics, understand what the actual market cap of AZERO is, because that I don't know for a certainty. So we'll have to follow up on that. And so I'll do a follow-up session on AZERO, another live, or maybe I'm going to try to get back to my Friday videos. But yeah, this one, how much time do we have left? Do we have questions or anything? Let me see here. Let me just hop over. This doesn't seem right. Is that their website, .org? Yeah. Okay. Again, this is a directed acyclic graph, mini H-bar, tiny market cap version of H-bar, Phantom, or IOTA. And very, so they've got some interconnectivity, and they're supposed to be rolling. I think their mainnet is also live. So MTV's mainnet is live, Multivac's mainnet is live, and so is AZERO just went live. Yeah, AZERO just went live. They're gonna have smart contracts out here pretty soon. I don't think currently. I think it's just the core chain that's online. I don't think smart contracts are live just yet, but I could be wrong about that. This one, all I've done so far is I dove into the technicals about the DAG consensus mechanism, and they make a statement in here that they're the only proof of stake public blockchain. Where's their statement at? That they're the only DAG that has truly distributed. I like the way that they kept the consensus mechanism decentralized, right? The DAG orchestration component of it is decentralized. That's the most important thing to me. Large rotating random committee to achieve proper decentralization. So I think this is a key thing, is that now that we have when Bitcoin was actually first developed, getting true random computational functions or feeds was actually a very difficult thing. And now Chainlink specifically is one that, for example, that they have a really good white paper on how they provide a truly random data feed. So you can subscribe to this data feed from Chainlink and get true randomness injected. So you can, it's a true random function. So you can then build off of that true randomization that you're getting from Chainlink. It's coming from a decentralized source at that, right? Decentralized source of true randomness. You can use that true randomness to build all kinds of really cool things after that. So, like, I talk occasionally about the idea of moving to like a proof of idle, where part of a proof of work networking is actually idle at any time it's not given. And with true randomness, we can make that type of stuff work. And this is the same thing that they're doing with their DAG, is they're using true randomness to do a rotation based on how they orchestrate the DAG. So the biggest problem with directed acyclic graph technologies is they all require orchestration. In order to have a DAG come to have a consensus based on a directed acyclic graph, this consensus mechanism has to be orchestrated somehow. And how do you orchestrate that? And the way that, again, Avalanche does it through the snowball mechanism, it's a very innovative way of doing it, and it is really decentralized, properly done, in my opinion. And then how Aleph Zero is doing is also actually decentralized, properly done. They're doing it through, again, a rotating and random committee, but it's based on true randomness being injected into the system. So it's impossible to predict who's going to be the next set of validators that validate and orchestrate the DAG, the graph. So I was very impressed with how they went about doing that. So that's why I'm interested in starting to build a very speculative position on this one as well. So now the other thing too is that I want to say this: as far as these new projects we're looking at, these might be the last 2 layer 1s that I ever look into, because at some point the new better layer 1 coming online and taking over and having a big stake in projects moving forward, it's going to be harder and harder and harder, because the incumbents are going to get they're going to get more and more network effect. Look at Ethereum, already has a ton of network effect, and it's, from a technology perspective, it is like ancient, right? How it operates today. But they're obviously making strides. Now, it's ancient in some ways, and it's very actually modern in other ways. What's really important, it's fairly modern, obviously, but with respect to a lot of these technologies, like how they're building out, Avalanche's snowball algorithm, or Ouroboros consensus for Cardano, or Multivac or Elrond's, adaptive sharding, or Aleph Zero, and right, it's pretty far behind, but it still maintains its network effect, because the things that matter, they're pretty much on the front lines on, and especially like with layer 2 scaling and stuff like that, they're pretty up to date. So these layer 1 projects are going to have a harder and harder time taking away market share, and especially when you look at like Multivac and Elrond and Cardano. Like let's go back to the big boys, Cardano and Elrond. In my opinion, those 2 blockchains are going to be nearly infinitely scalable. So at some point, like when you have infinite scale and near instant finality, right? When everything's rolled out, and there's others like Avalanche too, near infinite scale, near instant finality. When Ethereum gets to fully Ethereum 2.0, if you consider the whole layer 2 ecosystem, it too will be basically infinitely scalable and have pretty fast finality. I think that'll be the major lag for a while for Ethereum, but nonetheless, when you have those core metrics of like you're basically infinitely scalable and have near instant finality, there's very few metrics or differentiators you can have as a layer 1 project. So this is we're still so early in the game. I think there's room for more really innovative layer 1s to have a space to carve out their own niche, but it's becoming less and less so, right? So I think, again, with what I've seen from Avalanche, what I've seen from Elrond, I don't see there's a whole lot of room for this. But I think Multivac, Aleph Zero, they're still early enough. They have these type of projects anyway. I don't know if these two might flake out and go to zero. I don't know. So that's these are clearly not ones I'm putting a lot into, because I just don't know. They could just flake out and go to zero for all I know. They get no adoption. But over time, this will be the last couple of times I'm trying to get into these layer 1s. And the reason I like layer 1s up to this point in crypto's development is there's so much happening. There is so much. Let's go to the top, market cap list here. There is so much happening in the crypto space. It is impossible to keep up with all the small projects that are being launched all over the place. Look at the Polkadot ecosystem alone. I tried to keep up with Polkadot for a while. I just can't keep up. There's way too much going on in that one ecosystem. There is way. I would spend. I'd have multiple full-time jobs just trying to keep track of all of the projects that are developing on the Polkadot, Polkastarter, or Kusama, ecosystems. Right? It's a full-time job or more to keep up with those projects in that one ecosystem. And you look at everything else that's going on in those others. So the best way for me to get access to the best to get investment or to get exposure to the very best projects that are being built on these projects is to invest in the core project and not really be too consumed with individual smaller projects. As time goes on, as these top layer 1s get solidified in both their network effect and their niche, then there's going to be less space for these new ones that are coming up. So then it'll be time to turn attention to who's building interesting things on top of these these layer ones, which is what I've already started to do largely too. I've looked at others, but when I look at the space and I look at the projects that are being built on like Cardano or Elrond, anything outside of Ethereum or Bitcoin, it's still so new and nascent that it's hard to really have a good gauge on how to evaluate and how to value basically these projects that are being built on these. So it's a lot harder. So, but this is why I'm just back on looking at a couple more layer ones for now. But we'll get back to, as 2022 goes on, that'll be a shift of focus, is looking at, again, projects that are being built on these ecosystems and looking for really good potential. You know, there's a couple that I know I've seen some people get on the bandwagon of, a couple that I haven't, smaller projects that I haven't really got on the bandwagon of yet myself, that I don't see as super beneficial. But anyway, those are my thoughts. I hope this session was beneficial. All right, I think I'm going to wrap it here, and let's take a look at the price action here. Yeah, Bitcoin is just kind of, so we made this big move up, de-risk of, less risk of Russia invading Ukraine, and then the Federal Reserve. There's no risk of an emergency rate hike right now, and we see the market has responded in kind. So there you go. All right, everybody, thank you for your time. We are gonna wrap. Did I miss something here? I was looking at my Discord chat. I think people were chatting over here. Oh, no. I got a bunch of... Nope, never mind. Okay. All right, everybody take care. Let me throw back on my Doji Wave outro, and we will wrap this thing up. Let's do radar relation.